Good morning. I am Nataraja Upadhya. Welcome to the first edition of weekly mutual funds summary analysis in the Indian stock market context. This is something very nerdy, and any good, worthy, nerdy expression has something that can be scaled up or exploited. So I will talk about the celebration of Indian nerdiness at the end of this talk. Let us go to the topic. So the background here is that every week I download valuable mutual fund performance data from Value Research. For now, it is available free. I think slowly, once it becomes clear that it is so valuable, this data may not become available free, and then my both analysis and this kind of bulletins will end. So let's say have the fun while the fun lasts. So I'm going to my blog. Every week I publish my analysis in a blog. This blog you can find under Nat's Fun Corner. So basically this blog says top 50 funds based on 1 month and 1 year return as on April 20th, 24. So basically the market ends by Friday. So I do this analysis on a Saturday morning so that any batch uploads that comes to Value Research, I would assume, would have been done by Friday. And some mutual funds might have not given the data, but since this is an analysis at a summary level, using quantitative techniques, leveraging the Excel spreadsheet, that should be good enough. So from this week onwards, I am giving you a summary table upfront. So you can appreciate how the market has behaved from a mutual funds basis. If you look at any popular channels like CNBC or Z Business, you don't see much talk about mutual funds performance for the last 1 week. And I'm sure that this is, this bulletin will eventually influence that kind of changes. And whether it is possible or not, you go through my bulletin here and you make that judgment yourself. So looking at here, I am presenting most of my analysis based on the short-term data of mutual funds Value Research provides. By short-term Value Research means from 1 week return to 1 year return. So they provide data in terms of 1 week, 1 month return, 3 months return, 6 months return, and 1 year return. And I believe that this much data is enough for us to make sense of how the mutual funds are performing. And I'm trying to get some insight in a quantitative way as to which funds may be even worth considering for fresh investments. This is because when I started my mutual funds investments from June 2023, when some cash became available for me to start investing, I found that most of the recommendations are coming in a very haphazard manner. There are some ratings available, there are some stars available, but they don't change. So I felt maybe there is some kind of a commercial arrangement behind this kind of recommendations, and I needed an independent way of assessing it, and I figured that out through the quantitative analysis, and I'm trying to share it because I do this primarily for my benefit, but my nerdiness tells me that I should share this because there is some value that can be leveraged here. More than that, whatever stupid thing I'm trying to do here will have a butterfly effect, and the professional media will regroup and start doing something more useful. So let's look at the summary. See, top 50 average based on 1 month return. See, look at it. We have approximately 1,566 mutual funds belonging to different types of mutual funds, and this number is growing from year to year. Okay, in a very matured US market, the number of mutual funds may be way too much. So, but we are making progress. So the mutual funds investments is becoming more and more important. and especially for the newbies or the passive investors. Look at this week, we had a 12.18% as an average return of top 50 mutual funds. Though you can see that last 1 week there has been a correction in the market in various contexts, and in spite of that 1 week correction, we had 12.18% average monthly return. Now, I have started even giving the focus from a 1 year return because of volatility and correction. There could be so much confusion as to clarity as to where we should have the mutual fund investments. So even from a annual leaders, they have given 8.8% average return through the last week, while there has been a correction. You can see minus 1.24. And to appreciate how the churnout happens in the market, I also do bottom 50 analysis across all the mutual funds. And I do that both from 1 month and 1 year at an average level. And the specifics I give it at a 1 month level, because already there is so much data and people get confused. So I try to focus on important data only. See, on a 1 month basis, the bottom funds corrected by minus 4% this last week, and on a monthly basis they corrected from on a minus 4.59%. Okay, so obviously your mutual fund investments are not based on this top 50, so you definitely see some kind of a correction that hurts in your portfolio. Okay, now let us look at the value of this summary. See, if somehow you figure out a way of staying put with your mutual fund investments in a manner that you are going with the performance leaders, you can see what kind of returns you can expect. So top 50 average based on 1 month return gives you an annual return of 26.6 as of now. This is because most of the equity funds are still in the correction mode, and most of the funds that are doing well are commodity funds or some international equity based funds. So this number used to be much more low, something like 10% couple of weeks back. So this now changing to 26.6 tells you that some of the equity funds have started coming back, and that you can see in top 50 average based on 1 year is 8.8. Now, if you look at top 50 average based on 1 year return, their average annual return still remains to be 74.50. Before the correction started, this used to be something like 80%. So you could say that the 2 weeks or 2 months worth of correction have made only approximately 6% dent in the mutual fund returns when it comes to the annual leaders. Now, when you look at the bottom 50 average, the 1 month returns shows 17.4, even in the bottom side, but 1 year side, the lack of performance accumulates. It's almost getting almost no return, 1.24%. It is also useful to know how is the entire mutual fund universe is doing, and on a weekly basis. If you look at it, most of the funds are equity funds. There are some hybrid funds. You can see 819 mutual equity funds, 480 debt funds, 216 hybrid funds, and 51 commodity funds. So this is the mix up in Indian mutual funds based on the value research data that's available this week. So 26.79% is an annual return in the mutual fund universe. So if you take the percentage distributions, maybe slightly half, more than half of them are equity funds, and around 30% are debt funds. So another 15% are hybrid funds, and maybe 3 to 4% are commodity funds. So in this mix also we have 26.79%. That means your mutual fund portfolio, even with throwing a darts at the dartboard, that kind of randomness you should get 26.79% in India annual return. And if you are not getting, something is drastically wrong with your portfolio and you need to address it. Okay. So you need to figure it out, and listening to my blog on a weekly basis will make you more intelligent in your mutual fund analysis. So the first set of rows are all funds across all fund types together. Then I also give you summary by fund type. Let us go to the equity funds. So if you look at equity funds only, the top 50 equity funds gave 10.72% monthly return. Okay. And their annual return is 65.56. So there is a clarity among the equity funds as to who are the current performance leaders. So though there has been correction, there is also a kind of a surge against this correction. And on a 1 year return, the numbers will be typically match with respect to what we discussed across all fund types. That is because annual leaders on a 1 year basis are typically all mutual are equity funds only. That's why these numbers kind of match. We are yet to see other fund types being the annual leaders. And one way it is good because most of us are investing in equity funds. We don't want other funds being the annual leaders simply because if that is the case, then our equity funds are generally not doing that well. The hybrid funds or commodity funds typically do better than equity funds only through the correction phase of the market or the bear phase of the market. So it is good news that equities remain to be the annual leaders when it comes to the performance. See, so much clarity is coming from this set of summary data. So entire equity mutual fund average, when you look at only equities only, that has given you 40.57% of annual return across all 819. That means if you are a equity fund only investor, your portfolio should return this kind of percentage. For an investment you have made 1 year before. And if you are not, something is wrong with your investment strategy. See, even after 1.81% correction through last week, this average return of equity funds in the last 1 month were 3.93%. Okay. So this should be an eye opener for you. So if you are achieving less than 40% return in your mutual fund portfolio, if it is only equity based, something is wrong with that. You need to fix that. Let us look at debt funds. See, the debt funds are not really that relevant yet for individual investors in India because debt funds become attractive when the interest rates start going down. Otherwise, these debt funds give you return, I would say, even subpar to your fixed deposit returns. Today in India, fixed deposits you can achieve 8% easily, and if you are a senior citizen, you can even get an average of 9. Some small banks even give you 9.5% return on fixed deposit, but you need to ensure insurance, on such deposits. So that may be a limit as to how much money you can put on such deposits. But 8% is a good average for the current reality, and these debt funds sometimes come below that. So it is not really interesting, I would say, for now. But at the end of year 2024, debt funds may, emerge to be better return givers. So we can discuss at the time. Now, the hybrid funds have been a bit confusing in the Indian context because hybrid funds should be typically doing better than equity funds when the correction happens. But in India, these hybrid funds are more aggressively, tilted towards equity. So when the equity funds, correct, the equity portion of these hybrid funds also have been correcting. However, the intensity of correction may be less, but the intensity of return also is less. So net, the hybrid funds are always a bit of a subpar return compared to equity funds in India. However, on a standalone basis, they're still wonderful. For example, top 50 hybrid funds, they corrected only by minus 0.9%, 0.9% correction by a week, 4.41% gain, which is of course less than the equity funds. Then annual basis, they are given you 33.85%. Now, on a 1 year basis, that return is slightly better, which is 34.9%. So what it tells is, when it comes to hybrid funds, there is not much deviation when you compare to leaders across 1 month basis and 1 year basis. So that tells you that the hybrid funds are a bit more stable in terms of their returns. That is because they mix equity with other types, which is commodities and debt. Okay, so let us look at the entire hybrid mutual funds average across 216 funds. It is 22.04 and slightly less than 26.79 of all fund types, and way much different from equity funds average, which is 40.57%. But I would say that hybrid funds are still attractive in India, and if you are a bit feeling risky with the equity funds at any time, you can park your money in hybrid funds, at least some portion, and because their returns are quite decent. Now let us talk about commodity funds, because commodity funds have been very attractive for the last 3 months in India. Look at the numbers here. The commodity funds gave 11.85% return last 1 month, better than that. I am talking about top 50, better than the equity funds top 50. And the correction on a weekly basis is also very less. And on an annual basis, this has been 17.54%. Okay. But if you look at 6 months return basis, it is 19.73%, which means that there has been some commodity funds correction in the history more than 6 months. Between 6 months to 1 year, there has been some corrective phase. But in the last 3 months, commodity funds have given close to 17%. Okay, so that has improved your annual performance data. See, before this bullishness of commodity funds started, the annual returns of commodity funds was around 10% only. Now it is 17.54. We cannot say how long this bull run will happen. So when you stick to mutual funds with a particular theme, you need to be a bit careful, meaning you need to get out of the investment bandwagon when the correction of that particular theme starts. So we cannot assure that commodity funds will be bullish all throughout, but it could be. Commodity funds will, if they remain all throughout, then you will see something like 25% annual return through this year. So at least for now, you can stay invested, and you can even make fresh investments. For example, if you put some money 1 month back in some of the commodity funds, you would have gotten something like 11% return. On an annual basis, this becomes something like more than 120%, which is amazing. But remember, that will not happen across all the months. But right now, the current trend continues. You may have golden period in commodities, at least for next 1 or 2 months. Okay, that is the message here. So this is the summary. So this is how you should analyze the summary and take benefit of the insights from that. Now let us move on to the next part. See, I give commentary also in my blog. So this commentary should be read along with the data, then only you will appreciate it. So hopefully this video helps you how to combine the two and get the insights you deserve. Okay, so I'm coming to the second point here. When we compare the to the report from last week, we significant correction on 1 week basis, but the returns of top 50 for 1 month and 1 year are not much impacted through this last week correction. So this is useful information. Since some commodity funds performance are impacted, the 1 year return of top 50 based on 1 month return has improved through this week. So let me put this in a simple English. last week's top 50 mutual funds summary had a lesser annual return. This time it is more because last week the top 50 had more representation from the commodity funds, and this time some of the equity funds have come into that. Therefore, equity funds have better annual average. So top 50 annual average also has improved. So again, this is an insight by looking at the data. This is called quantitative analysis. So you would learn that by going through this block. Third one is slight reduction in the top 50 commodity funds 1 month return through this week reconfirms a bit of correction in the commodity funds. So maybe the commodity funds gave much better return, more than 11.83%, something like 12 point something in the last week's report. So that's the message here. Now let us go into the table of top 50 based on 1 month return. So I will zoom this screen so that you can read it better. So this is the top 50 mutual funds based on all mutual fund types. And you could see that at the bottom of this table, I cannot see it here. You can see it yourself in the box. Anyway, we have discussed the summaries already, so I will not go to the bottom. So you can see HDFC Defense Fund, which is an equity fund, has given you 16.33% return on a monthly basis. And this is relatively a new fund, so there is no 1 year return data for this. Similarly, another fund that has given you a good return is UTI Silver ETF Fund, which is also reasonably new. Now, here I do something which is useful for you. Based on the averages by the timeline, I highlight any returns which are higher than the average. For example, this in 1 month return, you can say I have highlighted all the returns above the average, which is 12.18 or something like that. So like that, I do it in all timelines from 1 month to 1 year. I don't give so much importance to 1 week because this is monthly return analysis, though we do it weekly. So that is interesting because in a month you get to know the monthly return summary at least 4 times in a week. That means if your investment window is on a monthly basis, you get 4 chances to get clarity, and you get to act across all these 4 chances. You can distribute your investment across these 4 weeks, or you can pick and wait and pick a particular week and go for an investment of particular clarity you like. For example, in this particular monthly summary for this week, whichever funds that have shown above average performance in all timelines from 1 month to 1 year, therefore represented by bold numbers, then I mark that row as green, light green. So here Murray Asset Nice FANG plus ETF fund of fund, it has been shown as an investment worthy for a couple of weeks now. But remember, though it is an Indian mutual fund, this invests in foreign equity, especially in US equity. Similarly, Murray Asset S&P 500 top 50 ETF FOF. Both of them are Indian mutual funds, but investing money in US equity. So the returns are pretty amazing. If you notice, one has given you annual return of 95.31, other one has 50%. So there has been a significant weekly correction on this also. So we don't know whether this correction will continue or this is one-off thing. So though these two have emerged as green, you may want to wait for 1 or 2 weeks to reconfirm their trendiness before you make investment on this, because they have shown a weekly correction. So that is a caution here. But other than these two funds, nobody else, no other fund among the top 50 pass the criteria that they should have a consistent above average return in all timelines. So you may wait and see. So maybe the correction will continue is the message here. So let us go back to the blog. I have written some of the commentary for this. So to read the commentary, I have to reset my Zoom here. Okay, looking at top 50 funds based on 1 month return, it is the same two funds like last week that made the investment criteria, which is to have above average return in all time frames from 1 month to 1 year. I keep repeating this because the new readers will not know this criteria, so I should not confuse them. So I keep repeating this statement in every blog. Most of the funds that made to the top 50 are the commodity funds like last time. So it is the commodity funds who are ruling in the top 50. It is interesting to note that two small cap index funds have made to the top 50 list after 4 to 6 weeks. So it is too early to reconfirm this as the revival of small cap funds. We need confirmation. So we need to see whether small cap funds can come back to the top 50. And it's for the first time I'm noticing that they have come back. So there is some celebration about it. So you can see it somewhere here. Okay, let me see whether I can catch it in this list. Axis Nifty Small Cap 50 Index Fund is one such thing. Then there is one more I remember. Aditya Birla Sun Life Nifty Small Cap 50 Index Fund. That means the small cap 50 index had some kind of a relative recovery within the corrections. Got it, no? So you cannot treat that as an absolute recovery. It is a relative recovery. So I would say wait and watch. I would say do not put money into small cap, fresh money into small cap funds until the small cap funds come into this green row zone. And when it happens, you can clearly see that. So wait and watch is what I would say. So let us continue further. Okay, so now we are going into analysis of top funds based on 1 year. We'll read the commentary. Let me first talk about the rows that are green here, which are because there is a correction in the mutual fund on a short-term basis, but you want to have a successive investment on a consistent fashion. You would like to depend on leaders based on top 50 performers on a 1 year basis. It is useful. This table is useful. If you can look at it, CPSE ETF is still a leader with a 103.49% annual return, though it had a weekly correction, and this weekly correction may continue. But in spite of that weekly correction, it has a return of 10.09%, which is much lower than the 1 month average of top 50 across all fund types. That's why this did not appear in the monthly leaders list, but it's still investment worthy. Okay. Though there is a caution that the corrections that are going on a weekly basis may erode into this percentage. So it depends on whether you are cautious or you have a faith that all the short-term corrections will be compensated soon enough. You can make the decision to have fresh investments based on this 1 year superior performance. So that the funds that have gone into green zone, other than the monthly, other than the ones that appear in the monthly list, are CPSE ETF, SBI PSU Fund, Motilal Oswal S&P BSE Enhanced Value ETF. Similarly, another one, Motilal Oswal BSE Enhanced Value Index Fund. There is a minor difference between ETF and the index fund with the same name. Basically, one considers the mutual the stock values at the end of the day only. The other one looks at it dynamically, I guess. That's the difference. UNESCO India PSC Equity Fund, Quant Infrastructure Fund, Bandhan Infrastructure Fund, and Quant Value Fund. So if you are fond of these funds and continue to invest, there is a reconfirmation here that they're still in the top 50 of annual performance. So that is the message here. So you feel good if you are holding on to these funds, or feel good if you want to start investing in these funds. So that is the message there. So I have put some analysis comments. Let me check whether there is more to it other than what I have already stated. One can appreciate the top 50 list based on 1 year return as a complement to top 50 list based on 1 month return. For example, the fund on the top row here, CPSE ETF, did not make it to the top 50. I talked about why it is. One may have temporary losses on a fresh investment on such funds in near future. If the correction continues, these funds are likely to be the winners for the future overall, as they have given above average performance for all the timelines from 1 month to 1 year. So the stress here is, because I look at consistent above average performance in all timelines, these rows marked in green tend to be the consistent performance. Therefore, your faith in them to recover quickly after the correction is well placed, is the message here. One can simply wait for another 1 or 2 weeks. Again, as I said, in a month you get 4 chances. So you can take any of these 4 chances, or you can act on every weekly basis. It is up to you. So now we are going to bottom 50s. This bottom 50 analysis is something I missed last week because it was hectic work. So I am reintroducing it. See, the bottom 50 helps us, the leaders within the correction. So it is interesting to know and who is doing really badly. And so when you look at this table, it becomes very clear, who are the guys, and it is very clear. All the IT-based funds are doing really badly. IT-based funds are doing so badly. Their annual return has come to below 30 on an average basis, I guess. So, so if you are sticking to an IT fund, your portfolio had a major impact, because these funds have been correcting since end of January. They were performance leaders in January, I remember. But after that, you have been losing money on these funds. So if you are still holding on to these funds, you need to think about it. Okay, you would have been a smart guy if you had, offloaded these funds in February. You would have saved a lot of corrections, right? Don't worry about it if you could not do it, but in future you can do it by reading my blog or going through this kind of commentary video. So other than the IT funds, who else is here? Let us look at it. Some foreign equities are also there. So for example, some Hang Seng based tech ETF. You have lost money in the last 1 year. Look, you invest the money in mutual funds to make money. But if you have invested in a fund and you have lost something like 20% annually, it is really sad. So that's what, when you go for a thematic fund, you have to be careful. I would say that if you want to be invested for a longer term, go for the themes that are going to be the winners for a longer period, like index based fund, or a large cap or a mid cap. You have to be careful. When your theme does not start working, you are better off offloading it and pay a short term gain tax of 15% than losing all the gains and getting into the loss zone. So some of the esoteric funds tend to be loss makers when the trend changes against them. Okay, so that is the purpose of this bottom 50. So go through that. See, for example, here some of the non-equity funds also will come here. For example, HSBC Asia Pacific ex Japan dividend yield fund has given you only 4.55%, which is much less than your bank FD. So it is not good. So these things happen. Got it, no? And some of these may emerge as leaders later. So that is, so it is better to keep an eye on the bottom 50 on a weekly basis. And I apologize for missing it in the last week's report. and I didn't mean to miss it. So we are moving on with our commentary. Here some commentary, maybe a repetition of what I said here. Only if something new is there, I will talk about it. So I'm going to point 9 now. When the correction of best performing first funds started in March, the bottom 50 showed an average 1-year return at the level of 70 plus, because at that time the most of the corrections were of the small cap funds which had superior returns prior correction above 80% average. But now it has come down to 26.6. This is partly because there has been so much correction consecutively, and also we could see that particular thematic funds like IT funds are ruling. That's why. So this variation becomes clear for you to understand how the market is behaving just by looking at the summary data of mutual funds. 10th point. So the bottom 50 list is useful as a warning signal for those holding such funds. Be happy if none of these bottom 50 are in your portfolio. It's an obvious statement. 11th point, as one can see, the bottom 50 funds based on 1 month return have bled significantly through last 1 week, causing an average weekly loss of 4%. Okay. And this loss is so much as their monthly average of minus 4.59%. That is, these funds lost most of their losses within the last 1 week. That's very sad. Okay. So now we are going to equity only funds. See, on a 1 month basis, we'll see some diversification of the leaders. So equity top 50 based on 1 month returns, we have HDFC Defense Fund, Quant Commodities Fund, Bandhan Infrastructure Fund, and DSP Tiger Fund. See, DSP Tiger Fund has come to the top after some time now. So let us look at DSP Tiger Fund. It has gained 10.85% in last 1 month, leading to 71.69 annual return for the last 1 year, which is very impressive. And look at Bandhan Infrastructure Fund, which has 79.74%. And Quant Commodities Fund is very interesting. See, the name may be a bit confusing because these are the equities that are based on commodities. Reliance Industries is also one such thing. And because of their dependency on commodities, 11.69% through last 1 month has elevated it to 79.74 annual. So I'm talking about Quant Commodities Fund. You can see 11.85% monthly. You cannot see annual data, but this is reasonably a new concept. This fund has been introduced in the last 3 months. So, so I have taken an exception here. Though there is no 6 months and 1 year data, I have chosen it to be a investment worthy, because I believe that 3 months performance is good enough, because commodities are doing well. So sometimes you have to take a judgment call and be ahead of the game and do well. So it may be worthy to invest in this Quant Commodities Fund as long as commodities rule, because their bullishness will be reflected with the underlying equities this fund has invested, is the message here. Similarly, HDFC Defense Fund is a relatively new fund. So I have taken the data available only up to 6 months and considered it as a investment worthy one. Okay. So let me see what else I might have mentioned in my blog other than what I already said, for the sake of completion. This way, this analysis does help to pick up the consistent winners from relatively new funds also. So that is the new message. That is the same thing I told, but I am re-stressing it. So performance history of minimum 3 months is mandated for such consideration. This statement for myself to be consistent in my analysis. Okay. So because I also learn as I go, and I keep improving this analysis and the report as I go. And if you have been reading it for a while, you will know that the changes that have been coming, and I hope those changes are more evolutionary than otherwise. So now I'm talking about equity top 50 funds based on 1 year return. Okay. So just to appreciate any diversification between 1 month and 1 year. See, as you can see, CPSE is the leader here. Okay. So the funds here are SBI PSU fund. We discussed all this. Quant Infrastructure Fund, Bandhan Infrastructure Fund, and Quant Value Fund. See these three: Quant Infrastructure Fund, Bandhan Infrastructure Fund, Quant Value Fund. These three came whether it is a 1 month leader in within equity or a 1 year leader. So when a fund appears both on a 1 month basis and 1 year basis, it's a further reconfirmation for you that you can trust these funds to do well as we go ahead. So, so if you're wondering what may be the safe bets when it comes to equity investments at this stage, I would say these three are better bets than those funds which give better returns in above, because they appear in both the lists. So that is something I didn't write about it, I guess, but you never know. So let me check that. What did I write? Unlike last week, the equity only top 50 based on 1 year return list has more fresh investment worthiness than that of all funds types. That means you are getting clear leaders among equity that are worthy of fresh investments. So CPSE ETF may have some more corrections in the weeks ahead, but it is negligible, I would say. You are safe with it. But if you want to save yourself from that correction, wait for another 2 weeks before making fresh investments on that. Is the message there. Next, I am talking about hybrid funds. Let us see the leaders within the hybrid funds. So again, like equity, hybrids also I treat for 1 month and 1 year, so that because the investment into hybrid funds is still relevant, though it is bit subpar to equity funds. The leader here is Quant Multi-Asset Fund. It had a minor correction through the week, but 8.11% return on a monthly basis and 50.67%. Quant Dynamic Asset Allocation Fund, JM Aggressive Hybrid Fund, ICICI Prudential Retirement Fund Hybrid Aggressive Plan, Kotak Multi-Asset Allocation Fund, Axis Retirement Savings Fund, Aditya Birla Sun Life Multi-Index Fund of Fund, ICICI Prudential Child Care Fund Gift Plan, Quant Absolute Fund, UTI Multi-Asset Allocation Fund. These have been marked green because they have shown above average return in all timelines from 1 month to 1 year. Again, I am looking at any exceptions here. No. HSBC Multi-Asset Allocation Fund, though it has given a superior 1 month return, I did not choose it because it doesn't have data beyond 1 month. So let us wait a bit. I said no, minimum 3 months we should wait. So that's why I have not picked it up. Quickly, let me go to the 1 year return before I go back to commentary. On a 1 year basis, the top 50, if I look at it, Quant Dynamic Asset Allocation Fund, JM Aggressive Hybrid Fund, Quant Multi-Asset Fund, ICICI Prudential Retirement Fund Hybrid Aggressive Plan, Bank of India Mid and Small Cap Equity and Debt Fund, which did not come in the monthly list, ICICI Prudential Child Care Fund Gift Plan, UTI Multi-Asset Allocation Fund, Quant Absolute Fund, and UNESCO India Aggressive Hybrid Fund. Again, the same consideration. Those funds which appeared in the top 1 month leader and top 1 year leader are safer bets. Okay. So, for example, Quant has dynamic asset plan, asset allocation, multi-asset fund, and absolute fund. And the best one probably here has been on an annual basis is Quant Dynamic Asset Allocation Fund, and it's also a monthly leader. So if you're a new investor and you want to go into hybrid fund, you cannot ignore Quant Dynamic Asset Allocation Fund is the message here. Let us see, is there anything worthy in my commentary to rehash? Okay, this So point number 15, it's only fair to say that the day of superior returns of hybrid funds when compared to equity only funds has not arrived at. When you compare the averages of top 50 based on both 1 month and 1 year across equity and hybrid funds, this point becomes clear. The point here is when the equity funds corrected, hybrid funds also corrected on an equal basis. So they did not give the benefit of hybrid funds because in theory, hybrid funds should give better returns than equity funds because they have some portion in other asset classes, which will not correct. But here that hasn't happened. So I am a bit, not happy about it because then why do I go for hybrid funds if it doesn't give me better returns than equity funds when equity funds are corrected? That. So that's my pet peeve here. Theoretically, one anticipates such time where top hybrid funds are likely to give better return than the top equity funds. Hence, looking at hybrid funds, top 50 list becomes relevant both from 1 month and 1 year list, which I discussed. See, what I'm trying to say is that there's maybe a particular hybrid fund which has done better than a particular equity fund. I'm not denying that. But if your investment is based on top 50 funds, equity funds are still negating the hybrid funds is my point. Okay. So hope you get that distinction than getting the confusion. So point number 17, far more hybrid funds become fresh investments worthy, marked in green, than the equity funds, as the benchmark average for these funds is lower within the universe of hybrid funds. Got it, no? Since the hybrid funds average is low, more hybrid funds have made above this average is the point. So it doesn't mean that hybrid funds are better than equity funds for now. That's the point there. It's more of a clarification so that one does not get confused. 18. I'm still curious as to when will I get to see performance of top hybrid funds being superior enough to beat the top equity funds. I'm also curious to see such hybrid funds in the top 50 across all fund types. Both has not happened so far. Maybe it is good news because that means equities are still the winners in India. Got it, no? If hybrid funds are better winners than equity funds, that means equity funds are giving you subpar performance, and you don't want to see that because you are mostly invested in equity. So there is a mixed message here. Is what I'm discussing here. Okay. So let's go to next one. 1 year return of hybrid funds we already saw. So the message here is the list of fresh investment over the hybrid funds based on 1 year return are slightly different when compared to top 50 of 1 month return. Definitely those funds which appear in both the list are more investment worthy because of the consistency is reconfirmed. Okay. So especially I'm very much attracted the fact that some, the quant funds are there because I have been seeing quant funds doing more better than other funds. Probably ICICI Prudential comes next when there is a consistent trend in the market. Now, whenever a trend changes in the mutual funds market, what happens is the consistent performers, take a hard dive, but they quickly recover and come back because money managers in these mutual funds do a lot of churning out, so they quickly come back to leader role because that is what they're used to. So the setbacks will be only for a few weeks. So that's why especially in hybrid funds we see quant funds, though they have been missing for a while in the equity funds, but they have come back in the equity funds also, like quant value fund, etc. Now let's discuss about commodity funds, the top 50, because commodities are doing well, continuously doing well. So here the commodity funds, look at it, the annual average of top 50 based on 1 month return is about 20 now. Got it, no? And on a monthly basis, they have given but more than 10%. This is amazing. And I personally look at commodity funds as a replacement for fixed deposits. So see, in fixed deposits, you commit to something like 3 years, 3 to 5 years commitment to get better interest rates. Whereas in mutual fund, you can take a ride with for 2 to 3 months or 6 months, depending on how long the trend continues, and enjoy these returns. So even now it is not too late to enter some of these funds, is what I said, because you may get at least 10% annual return by entering now. SBI Gold Fund is in the top for this month, through this week. Invesco India Gold ETF, LIC Mutual Fund Gold ETF, UTI Gold Exchange Traded Fund, Mirae Asset Gold ETF, UTI Gold ETF, Axis Gold ETF, HDFC Gold Fund, Kotak Gold Fund, Nippon India Gold Savings Fund. Now, your commodity fund investment is none of these, and it's something else. Don't worry. Let's take one quantum gold fund, for example. It has given you 12.08%, which is good, but it is a lagger in it's a lagger by being below the average. No, it is mainly a lagger in the 1 month base. So if you have invested in quantum gold fund, you should be happy. Got it, no? I am simply saying that if you're if you're making new investment, why go with the recent lagger? You may consider the recent, trendy one is the message here. So the funds which are not marked in green are also relevant. It is just for distinction I am marking it for green, because the whole purpose of this analysis is to identify the superior performance on a quantitative basis. So, for example, let's say you are very loyal to ICICI Prudential Fund House. So ICICI Prudential Regular Gold Savings Fund has given 11.81%, and it has been a consistent performer, because other timelines it's it's all bold. So you can stay invested, or you can even continue to invest, though it is slightly less in terms of performance. So I hope you get that distinction. So that's why this video is made, because I cannot write about every subtle points, because I do this as a nerd, as a hobby. So got it, no? So this video also I am doing it as a hobby and as a nerd. So again, there is all the insights I cannot talk about it. Okay. So let's see what I am saying here. Many commodity funds met the fresh investment criteria. Last week there was a churn out. Last week something interesting happened. No commodity fund could be marked in green, because there was a churn out between the past performance and the new performance. So the average got impacted in a manner that nobody made it to the average on a 1 month basis. So I could not mark anything in green. That kind of tells you that there is a churn out when it is coming to performance. So on such a week, I would say you wait, don't make fresh investments. Wait for a clear pattern to emerge. And this week it has emerged, is the message here. If a commodity fund continues to return more than 20% return annually, it's a way too attractive when compared to fixed deposit. So one needs to look at this list seriously, but if these funds correct significantly within the next 1 year, that will be a sub-performance than fixed deposit. So be careful. Watch out for commodity funds trend reversing. And how do you know that? By reading my report on a weekly basis, and or listening to this video. If you are too you find it too difficult to read this, of course, it's a very nerdy thing. So I would agree that if this blog was written by someone else, I wouldn't have read it myself. That's why I'm making a video, though it is worthy reading. So everybody cannot read, and I can read what I have written, but I also am very lazy to read someone else has written. That's why I have decided to make a video. So when the commodity funds start, correcting, there's a good chance that you may not get 20%, at least you will get a 10% annual return. So you can feel safe, therefore, and continue that investment until that correction is confirmed, and it's not yet confirmed. So I would say there is a ride for next 2 months, intuitively speaking. So final table in my in my blog is debt funds. Actually, there is nothing much to talk about. So what I said is debt funds top 50 is given only to reconfirm that there is no anomaly requiring discussion. So this anomaly starts appearing only when the interest rates start going down, and it can happen in India at the earliest is October is the projection now. So until then, I would say debt funds are boring, but debt funds are very relevant for institutional investors, and uh, some of the debt funds coverage is there in hybrid funds. So I will continue to cover to watch out. Is there any thing to look for? Otherwise, these numbers are below the fixed deposit return. So I'm not going to talk about it. So I have come to the end of my video. So I will just complete this video with something philosophical, because I tend to be philosophical, and whatever I engage in, I am fascinated by the philosophy of that. There is so much philosophy in the investments. There is so much philosophy within the mutual funds mm, investments in India, and there is so much philosophy in everything. And one thing I am very amazed by the philosophy of Indians nowadays is we are the best nerds in the world. So our strength is being the nerd we are. So don't be ashamed of your nerdiness. Okay, and the entire outsourcing to India was to celebrate the nerdiness of our IT professionals, and I was one of them. And I'm very proud of my nerdiness. Everything we do, if you do well, what stands out that is number one is nerdiness. It's not necessarily an adventure or leadership. We are the amazing nerds of this world. So be the nerd you are. And another way to put this is that I have been exposed to US for 10 years. So I am as much amazed by the Eastern principles, whether it's Indian philosophy or the Far East philosophy like the Zen Buddhism. I'm also equally amazed by the cowboy culture, the prickly cowboy culture, which talks about the reality with a sense of dry humor, lot of self-esteem, and arrogance. And I am also equally exposed to that, and I am equally influenced by that. So I tend to say that be the idiot you are, and stay the idiot you are. And this a lot of people in India find it very offensive. In fact, for me, the term idiot is very not only philosophical, it's spiritual, and I talk in that angle. But if some people get offended, it doesn't make me feel bad. I think the world is becoming multicultural, and I'm, for example, thanks to my 10 years exposure to US, I'm sitting in Bangalore and watch all the great global programs on OTT platform. So recently, one thing I'm really enjoying is Modern Family, which is not a new one, but it had a wave of it for 11 seasons, and I'm catching up now. It is a very trendy, something like Friends or Seinfeld or something else like MASH long time back. So there is one character called Phil Dunphy. Phil Dunphy is an average guy, but he's highly passionate, and he believes in what he does. He's trying to be a magician. He's not a renowned magician, but he spends a lot of money. He does a lot of stupidity and a lot of experiments, and it's lot hilarious to watch. Similarly, we Indians are quite hilarious as nerds, but we are the best nerds there. So I'm not ashamed of my nerdiness, because I'm an engineer, I'm an international consultant. And see, the best thing I learned as an international consultant is you give the best value, by being useful to the context and the people who are counting on you. And that best value comes. Now, the cowboy in me is talking, is buying the mistress you can be, the best mistress you can be. So that is an alignment focus. It is nothing amoral here, sorry, immoral here. So I say that, so I use the word mistress in terms of alignment, your customer alignment, user alignment. So that is my cowboy spirit talking. Got it, no? So I am also trying to be a best mistress here in this context. I started doing analysis for my own benefit. Then I started putting it to the customers out there without knowing who those customers are, whether they care. See, my blogs on an average only 40 people read, and even the first video I put there on the analysis of these blogs, only 40 people read. I don't care how many people read. I do care for those 40 people who had a faith to read. Maybe they may not come back. So I am another Phil Dunphy here doing my bit, but it has a butterfly effect. Got it? No? Whatever you do, you may not be a successful person, but success happens in the universe because of some stupidity you started. Remember the revolution of IPL in India? It's amazing, and I enjoy the IPL. But IPL did not start on its own. Before IPL, the real revolution came through something called ICL, and ICL was done outside BCCI, and it was led by, I think, Z and Kapil Dev, one of our eternal heroes. And BCCI became very upset because it got threatened, so much threatened. They quickly regrouped and started IPL. They not only started IPL, they squashed ICL also. Got it? Because they have so much feudal power, they can afford to do that. And they even put Kapil Dev in the blacklist, and still it is there settled. And Kapil Dev being a very graceful person and a hero, and he has survived it, and he has not become bitter. But in the world, what I'm trying to say is that the idiot being who you are and the Phil Dunphy being who you are, don't be ashamed to do your bit, your expression. Today with the internet and social platforms, it's an ideal opportunity for you to put out whatever nonsense you have. See, another thing I want to talk about is the nerdiness of Indians. You look at the success of India in any context, what rules is the nerdiness. For example, Bollywood is so much appreciated worldwide. And the funny thing in Bollywood is Bollywood songs and the dance. And if you look at those songs and dances, it is so nerdy. Got it, now? And only then you can appreciate that. Look at anything. The best example I give for the nerdiness of Indians is the even stand-up comedy. Our great stand-up comedians are all big nerds. I mean, amazing nerds. And when Amazon Prime did something, innovative, they brought something called Comicstan, I think, which went through 3 seasons. And more than the humor element, I'm watching Comicstan more to celebrate the nerdiness of Indians, even when they are the comedians, stand-up comedians. See, stand-up comedians tend to be a bit cynical, because the comedy comes best when you take a cynical angle on the reality. But if you look at the Comicstan, they have designed the program in such a manner. They have become a stand-up comedy university there. They will try to teach you different types of comedy, and so the what is more adorable for me is the nerdiness of Indians within India and across India. So be celebrative of your nerdiness. That is who we are, and be the best nerd you can be. Don't hold back, and you will see lot more Phil Dunphy out of me in coming weeks and months. I am above 60, and one day I may not get up from the bed, but you'll see a lot more nonsense from me. And this is one such attempt. Believe in the butterfly effect. Be the butterfly you are, and the fluttering you do as a butterfly has a lot more impact, though you may not individually benefit. But we are the Indians, so we always believe in Indian philosophy. Do your karma and don't worry about the results, right? So that is what we are. So our Indian philosophy has made us the best nerds in the world. So celebrate your nerdiness is the message. And see, look at CNBC. There is one guy called Anuj. He's amazing, and his insights, his analysis are so crisp. And every morning you want everybody in the channel as well as a viewer, you want to wait for Anuj. What is he going to say? And even that guy ends his speech with some quote, and it is his nerdiness talking. So he has figured out that he has to protect his nerdiness to be the best he can be. So that is the message I want to pass. Like Anuj out there, this is my message. This is my quote, and you'll see a lot more such nonsense in coming video. Thank you for your time. So I'm ending this now. See you next week again until this stupidity lasts. Thank you. Have a best one.